Van Gelder Financial. Van Gelder Financial is a family-owned financial advisory practice offering a variety of financial planning services, including comprehensive planning, investment management, income planning, college planning, and estate planning. Tony, I want to thank you personally for sponsoring today's webinar for all of us and would like to invite you to say a few words on behalf of Van Gelder Financial.
Yeah, thank you, Callie, for that, and for Greater North Fulton for putting on this webinar today. I'm excited because I think the conversation today comes at such a pivotal and unique time, given the economic uncertainty that we've gone through and probably will continue to go through in the coming months. Certainly for our clients, the pandemic exposed, how close to a financial cliff and how exposed we can be from an economic standpoint. And on the other hand, it also exposed that if you have a strong financial grasp on financial literacy and having a plan in place, then you can be uniquely positioned to capitalize on these types of opportunities. So whether your eyes have been, reopened, you've been through these types of dips and recessions before, or whether your eyes were open for the first time going through this, I think it's important that we don't let that opportunity slip away from us. So I think today's a really good opportunity for that. A little bit about Van Gelder Financial. We historically have done some of our best work with pre-retirees and retirees as they head into retirement. And while that certainly has been rewarding work, over the past couple of years, we've expanded that focus to include young working professionals as they really start to establish a game plan for their financial future. And historically, those people maybe aren't as accepted at a traditional financial firm. They don't have maybe an asset minimum or a certain amount of money yet for them to feel like they warrant a financial advisor. Whereas our unique approach says for a monthly subscription model, we can work with anyone. There's no asset minimums and no asset requirements to work with us, which I think is a unique approach. And then the second thing we've done to really try to cater to that younger generation is to focus on student loan management and student loan debt. There's, $1.6 trillion now in student loan debt, 45 million Americans kind of going through that. So it's certainly a big topic of discussion. So my goal for today and the conversation we're having is hopefully to bring value around those topics to the listeners and make sure we're better prepared as we come out of COVID and that we have protection as life continues to throw, curveballs our way in the future.
I certainly appreciate your comments, and I reflect back to my first job out of college when I was 21, and I was lucky enough to have a boss who was smart enough to say, you may not think you need it now, but it's time over money. And so, that stuck with me my entire professional career, and certainly hoping that the folks listening today, if they're at that point that they haven't started, get that message. So I appreciate what you're saying, and certainly your company and your sponsorship today as well. Now it's my pleasure to introduce our moderator for today. She is also the chair of our Chamber Foundation, Jennifer Hall with MatchKey Consulting. And MatchKey Consulting is a training and development organization with a key focus on professional millennials, which is younger than 40 years old. And of course, women of all ages in the marketplace. Formed in June of 2017, MatchKey's mission is to increase clients' comfort level around business development, strategic selling, empowerment, and confidence in the workplace. MatchKey programs are all customized and are available in group or individual sessions online, in person, Zoom, webinar, in micro-learning segments, or in a combination of platforms. Tony, you're right. We're kind of adapting to all the different platforms today and learning all of that. So Jennifer says people do business with people that they like and trust. And of course, building that trust takes time, patience, skill, and intentionality. MatchKey can help the clients develop those core competencies. Jennifer, thank you for all you do for the Chamber and for heading up our foundation, and certainly for being our moderator for today's panel. I'm going to turn it over to you.
Well, thank you, Callie. Thank you all for inviting me. And I'm looking forward, even though I'm not a millennial, to learning a lot as myself. So I'm excited to hear about some of the financial issues. And, as a parent of two younger people, setting up the future securely and knowing the value of some of these decisions that you're going to hear about today are critical. So I'm very excited to lead that charge. So let's get started. We've got a great panel of financial experts. So let me introduce them quickly, and then we will get started. So first, we have Kathy Healy. Kathy owns Wealth Management Advisors, and Kathy is a wonderful woman. I know her offline with other organizations. Tony, we heard from Tony a moment ago. Thank you again for your sponsorship. Tony, as he said, is in a financial company, family-owned business, focusing on student loans, which is incredible. I can't wait to hear about that. And Jeff Smith, I know Jeff well. Good to see you, Jeff, and thank you, Jeff. For those of you that don't know, is with Assurance Financial, and he's a senior loan officer and is going to talk about some real estate issues. So, Kathy, let's start out with you. And many of us have questions about retirement, and there's a lot of different types of numbers and codes that we hear about. I would love for you to explain those and maybe how to make the best decisions.
Thank you, Jennifer. I am Kathy Healy, and my firm is Healy Wealth Management. I've been working with individuals, families, and business owners in Atlanta since 2000, and I provide financial planning and portfolio management. I'm super excited to be part of this panel as we each give you some guidance trying to live comfortably today while making meaningful progress toward tomorrow. Today I'm going to talk a little bit about retirement saving in general, when you should start saving, how much. I'll go over traditional versus Roth IRAs, give you some tips on how to actually save, and touch on the dilemma that every one of us faces of competing financial goals. So traditionally, sources of income in retirement have included Social Security, which started in 1935, and pensions, which are retirement plans provided by companies for their employees or the government for jobs such as teachers. Now, very few companies offer pensions, and people are worried about the future of Social Security. So it's more important than ever for individuals to save to fund their own retirement. You should work towards saving 15% of your household income toward retirement. But don't let that sticker shock discourage you from starting somewhere. In a recent study conducted by Dave Ramsey Solutions, nearly half of Americans aren't saving for retirement. It can be a challenge because the expenses of the right now can get in the way. In 1999, MIT Age Lab was created to use practical ideas and technology to help people go into their later years. Most recently, they've been studying about retirement, and they came up with a division of our lifespan into 8,000 day segments. 8,000 days is about 22 years. So they divided it into birth to college, it's about 22 years, college to midlife, getting you to age 44 or so, another 22 years, 44 to 66, and then another 22 years, and then 66 and on, more than 22 years. In the early 1900s, the life expectancy for most of the industrial world was 50. Today, we're living into our 70s, 80s, and 90s, and so we need to plan for a longer retirement. So the key years are those 22 to 66-year-old years. During that time, you should save so you don't have to work your whole life. You might be getting married, buying a house, raising children, paying for college, and saving for a secure retirement. You'll have a job, you'll have a mortgage, you'll have expenses, and you'll also need to be saving. If you're in that 22 to 66-year-old phase, you may be starting your career, you may be in a second career, or have recently divorced, or you just feel behind in your retirement savings. The time to start to increase your saving is now and work toward that 15%. When I do financial planning for people, I ask if there's an age when they want to retire. Sometimes people say as soon as possible. Some people have a number in mind, like when I have $1 million or when I have $3 million. Some people say, I never plan to retire. I love what I do. Even when they have that feeling, we still want to create a plan that allows a financially secure retirement between 65 and 70. You may change your mind, or circumstances may not allow you to continue working. So before I tell you actually how to save for retirement, I want to give an overview of some of the different retirement accounts. First, the traditional IRA. The contribution is tax deductible, and the most you can contribute is $6,000 a year if you're under 50. If you're over 50, there's a catch-up provision, so you can contribute an extra $1,000 a year or $7,000. If you're married and your spouse doesn't work, they can also contribute to a spousal IRA of $6,000 or $7,000 a year, depending on their age. But if you or your spouse have a retirement plan through work and you make over a certain amount, you can't also deduct the traditional IRA contribution. The IRA grows tax deferred, and you can begin withdrawing at 59 and a half. When you do, that's when you pay tax. You pay ordinary income tax on the entire withdrawal, and you must begin withdrawing by age 72. The IRS has a calculation, and your financial institution will let you know how much you have to withdraw each year. If you miss your withdrawal, you're penalized 50%. So that's a thing you don't want to miss. Another type of IRA is a Roth. You can't contribute to a traditional IRA and a Roth in the same year unless it's in a 401k, which I'll talk about in a minute. The contribution is not tax deductible, but there are other advantages. There's no tax on the growth, so when you withdraw your money at retirement, you don't pay any taxes. No income tax, no capital gains tax, and you aren't required to withdraw at any age. After 59 and a half, if you had the account for at least 5 years, you can start withdrawing. You can withdraw sooner from a Roth IRA for disability, as long as you've had the account for 5 years. But there is an income phase out to be eligible to contribute once you reach $124,000 a year as a single earner or $196,000 for a married couple. So how do you save for retirement? Remember, a great goal for retirement is saving 15% of your income. But start where you can and work toward that amount. Here's how. Pay yourself first. If you're working for a company that offers a retirement plan like a 401k, that's the easiest way to start. The money comes out of your pay before you ever see your check. You won't miss it. It's best to allocate a percentage instead of a dollar amount, so when you get a pay raise, your 401k savings gets a pay raise too. And if your company offers any sort of matching, it should be a high priority for you to contribute enough to capture your company's maximum match. You don't want to leave free money on the table. Over half the companies who offer some type of retirement plan also offer a Roth 401k option, and 6 out of 10 people are choosing to contribute to the Roth. So how do you know which one to choose? A lot of popular advice now says to choose the Roth, but the best answer is customized to your own personal situation. If you're a high earner, you might want to choose the traditional. In the traditional, the money you contribute to your 401k is not included in your taxable income. Throughout the years, any gains are tax deferred, and you won't pay taxes until you begin withdrawing your money. Then it's taxed as ordinary income. If you're in a lower tax bracket, you might want to choose the Roth. You pay income tax on the amount you contribute. The company can also contribute a matching amount for you. When you withdraw, the portion you contributed and its associated gain are not taxed. Only the portion the employer contributed and that associated gain is taxed. You have access to the money after 5 years for disability, even if you're not 59 and a half. And just like the regular Roth IRA, there's not an age when you must begin withdrawing. So most people choose a combination, some combination of the two. If your company does not have a retirement plan, you can still set up automatic contributions from your checking account to your IRA periodically, and you can set it up monthly or every pay period. So regardless of your age or situation, here's a good rule of thumb for trying to achieve some balance here. Number one, contribute to your 401k at least the amount your company will match. Don't leave free money on the table. If you don't have a 401k, set up a monthly contribution to a Roth IRA. If you can do $500 per month, that gets you to the $6,000 maximum for each year. The second thing to do is beef up your emergency savings. Make sure you have $1,000 in emergency savings for things that come up like new tires for your car, and then work on saving 3 to 6 months expenses. Next, really tackle your debt. Next, save for down payment on your house. And after you've done all of those, work on increasing your retirement savings toward that goal of 15%, going first to your 401k, then to a Roth if you're under the income limits, and then saving in an investment account. I really appreciate each one of you for being on the call today. I hope that this is good information that encourages you and takes away some of the mystery about saving for retirement.
Thank you, Kathy. And remember, if you have a question, go ahead and put it in the chat box because we'll get to those towards the end. But thank you very much, Kathy. I'd like to turn it now over to Tony. Being a parent of 2 kids in college, I certainly am familiar with student loans. How to pay those off is always a challenge. So thank you for joining us again. Thank you for your sponsorship. Would love to hear some best practice ideas for managing some of the student debt and paying it off, especially when you're also trying to save for retirement. So it's a tough choice to make.
Yeah, absolutely. I think whether it's student loan debt or any debt, I think we take clients through a 3-step process, and I'll kind of cover that as we go. So the first step that's important to think about is what actually is your goal with the debt. That might sound a little bit funny because some people say, well, of course the goal is just to get rid of it and get rid of it as quick as possible. And I understand that, but what I mean by establishing the goal is the goal to pay it down as quick as possible? Do you have a good enough income to be able to do that? Is your goal actually just to get the lowest monthly payment possible? Maybe you're going through some employment difficulties, or you just don't have the room in your budget to make significant payments. So maybe your goal is lowest monthly payment. Or maybe your goal is, you know what, I just need to start making payments on time, improve my credit, and feel like I'm getting back on top of my debt. So as a very first step, we always encourage clients to say, okay, what is my goal with this student loan debt? Once you have established that goal, the second step we go through is to take an inventory of all of your student loan debt. And again, this might seem obvious to some people. We'll get clients to say, well, I know what I've got. I've got $50,000 or $60,000 in student loan debt. But what they don't realize when we talk about taking an inventory is that can be spread across multiple loans, that can be spread across multiple years, and that can be different types of student loan debt. If you went to school prior to 2010, your debt can be what's called Family Federal Education Loans, or FFEL loans. You could have Perkins loans. And then if you have debt after 2010, that could be what's called a direct federal loan. So understanding the inventory of what you have in student loans, the amount you owe, the interest that's accrued, and the date that you took out those loans is actually a really critical piece of information for us to then establish the plan down the road. The other thing that'll do is it'll delineate between what is my federal student loan debt and what is my private student loan debt. So the first step in taking that inventory is to go. Oh, we've got
she wants to leave them down here because she said we're going through them fast.
someone on mute,
The
maybe.
backup, so if you start
Yeah,
to run
I'm
them,
so sorry, Tony.
talk about upstairs. I don't need them.
There we
There
go.
we go. There we go. All right. I'll put this link in the chat once I'm done speaking, but it's the National Student Loan Database. The NSLDS is the best place to go to start getting an inventory of what do I have in student loan debt. And that's a great place to start. So step 1, establish the goal. Step 2, take an inventory. Step 3, then this is where we add the most value to our clients, is what programs do I qualify for based on my goal and based on the inventory of my loans? Do I qualify? Does it make sense to go after what's called an income-driven repayment plan on my federal loans? Meaning I will only make monthly payments based on the income I have right now, nothing to do with the size of my loan balance. So that can be a really powerful tool for younger borrowers to take advantage of. And then also, does deferment or forbearance or other options on my federal debt make the most sense? So the programs you qualify for and the steps you want to take initially in that third step of this plan is really, really important. So once you've done those first 3 steps, I think the other thing that's important to realize and to think about is the difference between federal loans and private loans. So before I went through a lot of the education to get what is called the Certified Student Loan Professional Designation, I would have said to any client, you know what, you're going to want to either refinance and pay down your debt as quick as possible, or you're just going to want to make the lowest monthly payment and put it off till later. It depends on your personal situation. But what I didn't realize is that when you tell someone to refinance their student loan debt and take their federal loans and make them private, they've now lost a ton of the flexibilities that you have with federal student loan debt. So some of those flexibilities that you have with federal student loans are things like deferment and forbearance. So while you're in school, you know, Jennifer, you mentioned you've got a couple kids in school. If they have student loans, they have the benefit of what's called in-school deferment, right? So they're a full-time student or at least a part-time student. They don't have to make payments, and their interest on their subsidized loans is not accruing while they're a student. Like as well, when you graduate, you have 6 months of grace period on your federal student loans where you don't have to start making payments yet while you're trying to find a job or get your income up. If you have refinanced your loans as you come out and they're private, you've lost that benefit of deferment or forbearance, which is another way to delay payments on your loans. So it's really, really critical. If you've got anyone in your life or you've heard that they're about to refinance their loans because interest rates are so low, it might make sense given their situation, but they need to understand what they're going to give up if they refinance and take their loans private. The other thing that you give up if you don't have federal student loans and they're private is the ability to go after those income-driven repayment plans. So someone with, let's say, $50,000 of income, but 6 figures of student loan debt is going to have multiple thousands of dollars a month in their payment. But if they get on an income-driven repayment plan, they can reduce that monthly payment into $300 to $400 to $500 a month. And that can be really beneficial if they're trying to qualify for a mortgage or other things in their life, a car. So you would lose that, again, if your loans have gone private, the income-driven repayment plan options. And then the big one that gets talked about a lot, sometimes gets negative press, is public service loan forgiveness. So this is only available to a borrower who has federal student loan debt and is on an income-driven repayment plan. And if you're in that category, you first must work for a qualifying employer. So this is anything in public service, a federal, a state, or a local agency, a 501c3, a nonprofit can qualify. If you work full-time for an employer like that, you're on an income-driven repayment plan, and you make 120 qualifying payments or 10 years of qualifying payments, then anything left on your student loan balance at the end of that is completely forgiven. So you'll hear a lot of negative press about public service loan forgiveness. You might have seen articles that say 98% of borrowers get denied on public service loan forgiveness, and it's all a fraud and it's going to go away. What people don't realize is that it's very intricate to, one, make sure you make qualifying payments, those 120 payments, to make sure you're with a qualifying employer, and to recertify your income every single year on your income-driven repayment plan. And so the majority of people that don't get the benefit of a public service loan forgiveness after the fact are the ones that didn't follow those steps. And that's where we can add a lot of value and a lot of help. So I think that's a good overview of federal versus private, and why it's important to really think about that carefully before you refinance to a lower interest rate and go private on your student loans. Switching gears a little bit into what's going on right now with COVID and the CARES Act and federal student loan debt. We're getting a lot of questions about this from clients right now, is that if you have student loans between March 30th and September 30th, 2020, the CARES Act has said that those loans are on pause. They have a 0% interest rate. So no matter your balance, no matter your income, whatever your situation, you owe $0 during this time now for the next 3 months before the end of September on your student loan. Should I still be paying even though I don't owe anything, or should I be doing something else with that money? Our opinion is that right now, the best option for someone with student loan debt that has this 0% interest is to save up as much as they can in an emergency fund. It doesn't mean that after September, they don't have that savings that they can then throw at the student loans should they need to. But given the uncertainty of employment and the economy, we think it's really important right now to focus on an emergency fund, building up a savings buffer. And who knows what's going to happen between now and September. Congress could push that CARES Act out further, and those loans could be delayed even further. And the other benefit is, even though you're paying $0, those are counting towards public service loan forgiveness, or those 120 qualifying payments that we talked about earlier. So take advantage of that, save up on the side, and then if you need to, you can throw that money toward those loans after September when you need to attack the debt again. I think a couple final points I would say, not specific to student loans, but any debt, is there's a couple different schools of thought about how to tackle debt. So one of those schools of thought is the debt snowball. This has been made popular by Dave Ramsey that Kathy mentioned earlier. This is where you list all of your debts, smallest to largest. You make minimum payments on everything, and then anything left over, you throw everything at the smallest balance of your debts. This is regardless of interest rate, but you make it a point to pay down your smallest debt first, and then once that's done, you snowball what you were making payments on there to the next largest debt. The second school of thought is what's called the debt avalanche, meaning, again, you list all your debts out, but now anything you have left over after making minimum payments on everything, you throw at the highest interest debt that you have. And certainly from a math point of view, that makes a whole lot of sense, because let's say you've got credit cards that are in the 20% range on interest. A lot of times making extra payments there from a mathematical point makes a lot of sense. But math and behavior when it comes to personal finance are two competing priorities. And in our experience, the debt snowball, where you can start to see quick wins and get rid of debt, even though it's a smaller interest rate, but you get rid of the smallest debt balances first, actually can get a lot of wins on the board and can give you some motivation to keep going as you pay off your debt. So I hope that helps, at least with student loan debt and some different ways to tackle debt in general. And that's what I've got.
Excellent, Tony. Thank you so much. I am impressed with being a certified student loan professional. I have not heard of that. So you're obviously the one to go to for these questions. All right, last but not least, and also don't forget, if you have a question for Tony, please put it in the chat box and we'll get to it at the end. So Jeff, the American dream, getting that house. So Jeff is a senior loan officer with extensive mortgage loan experience, and purchasing your first house is very exciting, but oh my gosh, there's so many letters and acronyms and loan types, and hopefully you can spend a few minutes talking us through that and how to apply and what's PMI and all that good stuff. So so Jeff, I'm going to turn over to you.
Thank you, Jennifer. So good to see you. And I guess we've been talking about being responsible. Let's talk about buying something. Let's talk about something fun now for a second. But really, everything Kathy and Tony just said, I was writing some stuff down as well. And if you follow their advice, you'll be in much better shape when you come to me to be able to, get a bigger loan at the best rate possible. So it was great advice. And, I actually joined the chamber here back in 1999, if you can believe that. North Fulton's just been an incredible spot to grow my business. And I just want to thank Callie and the whole team over there for all the work that they've done to create a wonderful environment for us to, I've really established some of my best business relationships here. And I want to thank them for doing that and for having me on this panel today. So I'm a mortgage banker, and I've really been involved in real estate since about 2004. Learned a lot of hard lessons in 2008, as did our entire industry. Our entire industry changed after, they kind of blamed us for breaking the whole entire economy. But we had a lot of help, and there were a lot of good rules and regulations put in place, but a lot of redundancy and a lot of checks and balances. In my opinion, it's a much safer way to get a mortgage now in this industry. Things are a lot more controlled, but there's a lot more paperwork to sign. At Assurance Financial, I've been here since 2013. This week actually marks my 7-year anniversary here at this company. We have a branch here in North Fulton, and our headquarters is in Baton Rouge, Louisiana. There's a lot of different kinds of lenders out there. So you have your banks on one side, your big banks, your Chase, your Wells Fargo, and you have your brokers on the other, who are more your almost like independent sales reps, right? They can get you, shop you around, find you the best rate, and then hand you off to that lender once it's time to get a loan. We're kind of a correspondent. We're somewhere right in the middle, where we do everything in-house. All of our underwriting is in-house and decision-making, and yet we still hedge our rates against all of the other banks out there. So when we pull rates, we're looking at 20 to 30 other rates that I can shop around, but we still control the processing. So in my opinion, I've stayed here for 7 years because it's the best way to offer the best customer service for my clients. What I'll say is my style is really a consultative experience for my client. I prefer my clients. People ask me, when should I get a pre-approval? And it's not, that time is not when you're under contract with a house. Nor is it right before you want to go under contract with a house. To me, the best time to go is well before. The sooner the better, to be honest. My job is really to get you, and I love nothing better than to have my clients well ahead of when they're planning on buying a house, so we can look at their entire financial picture, their credit history, and put a plan together for what they can do leading up to that home purchase to put them in the position of not only being able to get the best rate, but also have the best product, know what to save for, and put themselves in the best financial position for themselves and their family. And I encourage everybody to find somebody you trust in any of this. You can only Google so much. 10 years ago, Google was a great place for honest and good information, but these days, the marketing people are just so smart. There's a lot of bad information out there that's dressed up to look like good information, and you're not going to pay anything extra usually with this kind of stuff. So find somebody that you trust and that seems to know what they're doing. So the pre-approval process is really a lot more than me just telling you how much you approved for and what kind of an interest rate you might get. It gives me the opportunity to look at things and figure out how we can not only get you a bigger loan, but also get you a better rate, right? Put you in a better financial position. There's 3 things that all of us lenders look at when we're trying to determine your maximum loan size and what interest rate you're going to get. And that's your down payment, your credit score, and your debt to income ratio. In some ways, it's very simple. In other ways, it can be very complicated. Some of it depends on your personal financial profile. But if I can look at your profile now and you plan to buy a house in a year, I can tell you what you need to do over the course of that year to put yourself in a great position. So let's talk about a couple things. So down payment. So how much do you need to close on a new house? 20% is a number that gets thrown out there, and it certainly is a very important marker. But by no means do you have to have 20% to buy a house these days. You can put as little as 5% down on a conventional loan, or even 3% down if you're a first-time home buyer. The reason 20% is important is because if you put less than 20% down, you pay that wonderful thing that Jennifer referred to called PMI, or private mortgage insurance. It's basically a monthly premium that's added to your mortgage payment. And how much you pay is determined upon how much you put down in your credit score. So if you have like a 785 credit score and you're putting 15% down, you know, you may be paying somewhere between $40 and $80 a month extra, depending on the loan size. But if you're putting 5% down or 3% down and your credit score is under 700, all of a sudden that could jump very quickly up to $200, $300, $350 a month. So, you know, PMI is kind of a necessary evil. It allows us to be able to put less than 20% down. It's not necessarily a killer, especially if you try to compare that to the amount of equity that you may be gaining in value of your house over the years, and versus what you may be paying someone else to pay their mortgage as you pay rent over the course of a year. So the second thing I want to talk about is credit scores. So when I started at Assurance back in 2013, we were really still smarting from the crash in 2008. And back then, if you didn't know how to help somebody get their credit score up, then you were not going to have a whole lot of deals, because there were a lot of people out there that didn't have the ability to save the money, were using their savings and weren't able to pay bills. It was a rough period that we came out of. But as such, I learned how to almost, I consider myself kind of an expert on getting people's credit up. I give a lot of credit to my software system I have, where I can pull people's credit profile in, and I can play with it, and I can pay things off, and it'll tell me exactly how the credit scores on the 3 bureaus change. So, you know, to qualify you for a mortgage, us lenders, we use the FICO score model for all 3 credit bureaus: Equifax, Experian, and TransUnion. And that's different. It's a different model than what most of you are going to see. You know, if one of your credit cards tells you what your score is, or if you're paying for a service to tell you what a score is, for whatever reason, our model, the lenders, the lending industry's model, the FICO model, is different than what you're seeing. I don't know why. I just know it's true, because every time I tell someone the credit score, they're surprised. It's either a lot lower or a lot higher. But I know that we do have a different model. So that's another reason why you probably want to get with us as soon as possible. To number one, find out maybe there's a hurdle. I had somebody earlier this year that did not know that they had a credit card that had a balance on it. They had paid it off the year before, and interest had accrued. So they paid it off, but on their next bill, there was interest. They didn't look at the bills that come in the mail. They didn't go check on it. And so they had about 7 30-day late penalties on their credit score, and it just demolished their credit score just because they had, and it started off something like $25 that was on the balance, and they just didn't pay it. So, and it really hurt it. So as an expert in helping you get your credit, you know, there's 3 things that I'll recommend here that you do. Number one, and this is the most obvious thing, but I'm going to say it because it's that important, you know, pay things on time. Do not let anything go 30 days without making that payment. It kills your score. It really kills it. I've seen somebody with 1 30-day late payment on a credit card get their score driven down by 30 points, which drove their interest rate up by 3/8 of a percentage point. So, you know, whatever you do, take that serious and be diligent about making your payments every month on all credit things, anything you're borrowing money for, cars, credit cards. Speaking of credit cards, so try to keep your balances less than 30% of the limit. That seems to be the dividing line, where if you're above that limit, it starts taking points off of your credit score. And if you're below that limit, it starts putting points on, as long as you're making your payments on time. So, you know, if you're like my brother, what you'll do is you'll get a card that gives great points, like American Express or something. You'll use it to buy everything in your house for an entire month, and then you pay it off every month. He's an engineer. He's very diligent. Tony and Kathy would love to see his financial record. You know, he's very disciplined, and he does that. If you're not the type of person to do that, don't do that. But if you can, it's a great way to get your score up and create positive credit history, which brings me to my third point: have credit. So we're in the business of lending hundreds of thousands of dollars. Unfortunately, we have to have some sort of system that tells us your record of paying loans back. And I've had a number of people over the years that come to me, and they're so proud to tell me they have no debt at all and no credit, and they've never gotten a credit card, and you know, they never had to get a loan. And it is something to be proud of. It takes a lot of discipline to do that, But unfortunately, your credit score is not only made up of negative history where points come off, it's also made up of positive history where you're building up a credit history. And so I've had people come in that have never had any debt, not one negative thing on their credit report, yet their scores are in the low 600s or even the high 500s because they just got no debt. So if you're one of those people, go ahead and just get a credit card or two, get as high a limit as you can, and go ahead and use it, once a month or every other month or something like that. Just demonstrate your ability to pay credit back, and that's going to give you a high credit score. And when you come to me, it's going to enable me to be able to give you the best rate that we offer. So, lastly, there's a lot of different loan programs out there and a lot of ways to structure a loan. If you're a veteran, there is no reason you shouldn't own a house right now. VA loans are the best on the market. Some of the lowest rates on the market. You don't have to put anything down. No paid mortgage insurance, right? You can put nothing down and have no mortgage insurance. If you're not a veteran, go find one and marry the veteran, because the mortgages are that great. They really are. And I love doing VA loans. If you want to buy land and build on it, you can do a construction to permanent loan. If you're a business owner and told you can't get a conventional loan because of your tax returns, we now do bank statement loans. They're not wonderful loans. Their interest rates are high, but it does give us the ability to get you a loan and get you in a house. And then maybe a year down the road, we can refinance into a conventional or an FHA loan. If you're buying a house way out in the country, you can take advantage of a USDA loan. These are also great loans where you don't have to put anything down, and those loans will actually pay closing costs in some instances. The qualifications are a little stricter in some regard, but it's a great loan. So, the bottom line is, if you're thinking about buying a home or refinancing a home for a better rate to get cash out, please call. I absolutely love getting people ready for a home loan. You will never be bothering a loan officer by saying, hey, I'm thinking about buying a house in a year, and I'd like for you to pre-qualify me, and so I can start getting an idea of what I need to be doing. It is a much better experience for everybody if we can prepare and get you ready, as opposed to have to do a fire drill right at the last second, and all of a sudden you're having to take hours off work and find documents you didn't know you had to get, and all that kind of stuff. I love my industry. I get to be right in the middle of somebody making the most emotional and sometimes the most meaningful investment in their entire life. And so because of that, it can be an amazing experience, and also can be an incredibly frustrating experience. So the more you prepare for that, the more rewarding and awesome of an experience it'll be to buy a new house, get new neighbors, and enjoy a new neighborhood. So the more you know and more comfortable you are with the process of buying a home, the more easier and enjoyable it will be. So call me if you need any pre-approval. Get in touch with somebody that you know and trust, and get some questions answered. The more prepared you are, the easier it'll be, and the better position you'll be to get a great loan at a great rate. So that's what I've got. Thanks for letting me be here. And like everybody else, I'll answer some questions if anybody has any.
Thank you, Jeff. I'll tell you, getting a mortgage is more of an art than science. So I will echo your come see you early and have an advocate as you go through that process. So that's great advice.
Thank you, Jen.
Excellent. Well, Rachel, it looks like we've got some great questions, and I'm going to turn it over to you so we've got time to answer them all.
Yes, we have a bunch. I'm so excited. So one of the first questions I got is kind of goes back to that emergency fund and savings. It was just touched on a little bit, but someone asked, how do I decide how much I need in an emergency fund? And should I focus on the emergency fund before I focus on paying off other debts? So anyone who wants to answer that.
I'll take that. I really do like Dave Ramsey's advice that he calls 7 baby steps, which goes through the steps that anybody should take if they're starting out in their financial life or if they've run across roadblocks. And he recommends $1,000 emergency savings, and that is a high priority. And you've got to balance it, what Tony talked about, with paying off the debt. So make sure that you're not, and what Jeff said, don't miss any debt payments. Pay the minimum if you need to, but get that $1,000 saved.
Awesome. Thank you, Kathy. And then we have a question from Mary Beth. How far in advance of buying a home should we talk to a lender?
That'd be me. Again, I would go as soon as possible. If you're thinking about buying a home, and you're not sure when you're going to buy the home, call a lender and get pre-qualified, get those questions answered, take those variables out of the equation. They may show you that you can buy a house sooner than you think, or they may show you that maybe you need to wait a little bit longer to get yourself in a better position. So I would say right now, I've had people come to me as, a whole year in advance or 2 years in advance. I just had a client last week, we went binding and I pre-qualified her 2 years ago. And so she decided now was the right time. So I would say right now.
So kind of bouncing off of that, how early can someone get pre-approved?
Well, so pre-approval is really the kind of thing where, it's the same answer. Pre-approval is really the kind of thing where we're looking at your profile and we're telling you, if nothing changes, you're going to qualify for a loan. So
Okay.
People ask me, hey, how long is a pre-approval good for? And I'll say as long as nothing changes.
Awesome. And I think this one will be more for Tony and him talking about snowballing that debt. Is it a good idea to use a 0% interest card to consolidate and pay off credit card debt?
Yeah, I think this kind of goes to the math versus behavioral finance I was talking about earlier. So from a math point of view, absolutely, it can make a lot of sense, right? If you can shift, let's say 20, sometimes even up to 29% credit card debt onto a 0% interest card and start paying that off at a much lower interest rate, then I think that makes a lot of sense. One thing to keep in mind, though, with those transfers is that usually it's an introductory teaser rate, right? So that 0% might be good for 12 months, 18 months, sometimes up to 2 years, but people get caught out because they start making payments, but they haven't fully paid it off, and then they're right back in the cycle. So I think before doing that transfer to a 0% card, I would say, look at your budget, start managing your cash flow, and make sure you can responsibly pay off that debt. Think about the behavioral side of the root cause of the problem of why you got here in the first place, and don't see this as the only solution to fix all your problems.
Great answer. Thank you so much, Tony. And this one I think goes back to Kathy. Is it important to max out your retirement investments each year?
Well, you do have to consider all the competing goals that you have. So sometimes you're saving even for your children's college education, but if you can max out your retirement savings, that's great. So I'm a fan of that, but you can't let other things go.
Awesome. Thanks, Kathy. And Jeff, heading on back to you. Is it wise for someone over 60 to purchase a home?
Well, in some ways I might throw that back to Tony or Kathy. Everybody's got a different financial makeup. As a lender, we are not allowed to discriminate. I did a 30-year mortgage 2 years ago for an 89-year-old woman, and she qualified for the mortgage, and in her eyes, she felt better about holding on to her cash in making a mortgage payment. She would rather make a monthly mortgage payment than lose out on having the safety net of that cash being held somewhere. So the wisdom, I would say, talk to your financial advisor, because everybody's in a different position, but you can do it, that's for sure.
Awesome. Another one just came in for you, Jeff. Is it a buyer's or seller's market right now? Is this a good time to purchase a first-time home during COVID-19?
Well, it is a great time to purchase a home right now. And I've been saying that since really 2012, when the market totally bottomed out after the crash. The home values have done nothing but go up. And so what I've been telling people, there was no better time to buy a house than yesterday, because, in a year from now, home values are going up just about easily 5% every single year. So that could mean $15,000 on a $300,000 house more that you're paying next year versus this year. And you missed out on that equity if you'd have bought it this year. So right now, during the COVID, it's definitely an interesting time. It's an interesting market. The realtors are having a heck of a time trying to show houses. where people don't want to come in and people are buying houses online. But it's a very competitive market. In some price ranges, I would say under 400,000, it is still a seller's market, which is driving prices up, which gives you even more reason to go out there and buy a house. But above that, it starts, and the higher you go, it becomes more and more of a buyer's market.
Awesome, thanks. That's great. So basically, it is a buyer's market, people. So another quick question we had, and this applies to me, I use Robinhood. So I'm not sure who might be best to answer this, but do you think that apps such as Robinhood or Stash are useful early on to get started in investing? So whoever wants to grab that one.
Yeah, I can take a stab at it. So I think Robinhood has gotten a lot of negative press recently because of the kind of FOMO thing with the stock market, right? People have seen what's happened since March 23rd, and the market has just gone gangbusters back up. And you get a lot of, if you will, novice investors using these apps trying to get rich quick. I think any app that automates your savings can be a really powerful tool. But I think how you're saving that money and the funds or the different investments you're choosing inside that app is actually the more important factor, right? So if you're choosing individual stocks and you're seeing this as a retirement fund, then I think that's where it can get really dangerous. So the automation aspect of those apps, I think, can be really powerful. But I think what you're investing in, and again, I'm biased, this is where a financial advisor comes into play. What you're investing in for the long term or the short term makes a whole lot of difference.
That's a great answer, because I actually use Robinhood just kind of to have that savings that grows, and I also have the high percentage savings account. So yeah, I don't use that as my retirement, but I was really interested in that question as well. So thanks so much, Tony. And then we have another question. So about how much would an average for a CFP charge per hour? And then how many hours a year or how often would you suggest someone meet with their certified financial planner or wherever? How often do you think that they should meet? And you guys can all answer this. So I think they're just trying to get some guidance as to how much to kind of plan to budget for a CFP if they want to hire one, and how much or how often they should kind of plan to meet and go over their finances.
Tony, why don't you go ahead?
Sure. Yeah. So the short answer is it depends. The longer answer, I would say, a lot of advisors, if you've got assets to invest, rather than charging on an hourly basis, they'll charge a percent of the assets under management that they're looking after, right? So if you've got $100,000, a typical fee for an advisor might be 1%, meaning that you're going to pay $1,000 throughout the course of the year, maybe every quarter, maybe every month, for that advisor's work. Some advisors do offer hourly rates, but that ranges so drastically, right? It's like saying, what's an hourly rate for a lawyer? I mean, you could get someone that says $100 an hour, you could get someone that says $500 an hour. So I don't think that's an answer that it has to be one size fits all. In terms of how often, one of the things I've, I guess, come to appreciate and see is that as advisors, we tend to think we should meet more often sometimes than what the client actually wants to meet. So some people actually prefer, especially in the COVID world, a couple times a year can be more than enough for the majority of the clients we work with. Some clients like to meet as often as quarterly, depending on if they're in a stage of life that has a lot of change. Maybe they're having children or buying a home for the first time or starting to really save for retirement. Meeting quarterly can be a powerful thing in those periods of time where you've got a lot of change going on. So Kathy, I don't know if you would add anything to that or change anything about that.
Yeah, I completely agree with Tony on all of that. I do suggest that everybody go to Dave Ramsey website and look at the 7 baby steps, because, without even paying a financial planner, everybody can start on those steps. They're just great.
Awesome. I actually have one more question for you, Kathy. So let's say you quit a job. how do you move over that money between your investment accounts if that's what you want to do?
So if you want to roll over, it's called a 401k rollover. If you want to move it to an IRA, and you just open an IRA at the firm where you want to go. And some employers, it's a phone call. You call your employer plan, and they move it over just on your phone call with your new advisor. Sometimes there's paperwork, but it's an easy process.
Awesome. We have one last question, whoever wants to answer it. And it's a question I've had before too. Why are credit scores negatively impacted when someone runs your credit, like an apartment or a car? Because I would like to know that too. So whoever would like to explain.
Well, I guess I could take that since I'm the self-proclaimed expert.
Mm-hmm.
You know, there's a lot of the algorithms and their scoring models I understand. Some of them I don't. You know, I could see where when you get multiple pulls from different credit card companies, for example, why that would hurt your credit score. You know, that's a sign that somebody's starved for cash and they're trying to find some quickly, and that could be a red flag. Just getting pulled because you're getting an apartment, I'm not sure when, or even getting it pulled if you get a car loan, when that car loan actually in paying it positively could give you positive points. I'm not sure why that should get your score down. But usually those pulls and things like that, usually from what I see, while you may drop some points, and the less pulls you have, the less one pull is going to be affecting your score. So usually it may drop your score for a little bit, but they tend to recover pretty quickly from the credit pulls. Whereas if you didn't make a 30-day late payment, it's going to take a lot longer to get away from that wound.
Awesome. Thank you so much, Jeff, for clearing that up. And I think that's all the questions we have. So I'm going to bring us on home and wrap up. My name is Rachel Dangerfield, and I'm the Leadership Programs Coordinator here at GNFCC. I oversee NextGen Connects, Leadership North Fulton, and our Emerging Leaders programs. I would like to thank today's panelists, Kathy Healy with Healy Wealth Management, Tony with Van Gelder Financial, and of course, Jeff Smith with Assurance. And Jennifer Hall has been our wonderful moderator from Matchkey Consulting. And special thanks again to Van Gelder Financial for sponsoring this panel. We all got so much out of it, and I really want to thank you. And these have been important topics for our members and our young professionals. So we really appreciate all of you being here and taking your time and sharing your expertise. And so NextGen Connects is a program of the Greater North Fulton Chamber. Our mission is to engage, recognize, and develop future leaders. And so we'll hope that you will all come back in person and join us for future NextGen events. And be sure to check out the Chamber's website, gnfcc.com, for all of our upcoming events. Thank you for joining us, and have a great day. And we will be having a NextGen Social coming up later this summer, so I'll send out some more information on that a little closer to time, but we are very excited to see all of you in person. So thanks so much for being here.
Take care.
Thanks.
Bye.
Bye-bye.